If you've gone to a bank branch, well, not recently because a lot of people aren't stepping out as much as they have in the past, but you probably have been approached by somebody offering you a ULIP, a unit linked insurance policy. If you're not familiar with it, then this conversation is meant for you. And if you are familiar with it, then this conversation is still for you because we'll be talking about the latest tax rules. And there was a clarification that was issued recently by the CBDT with respect to a change that was introduced in last year's budget. Let me introduce my guest. We've got Arvind Rao, who is a chartered accountant, certified financial planner, and the founder of Arvind Rao and Associates. Arvind, thank you so much, as always, for taking the time and for speaking to ET Now. Let's start with the most basic question. For those people who are not familiar with ULIPs or unit-linked insurance policies, what is it? How does it work? What instruments does it invest in?
Hi, Alex, and thank you for having me here. So, as insurance industry matured, in the past, what are today known as the traditional insurance plans, these basically meant policies which predominantly invested in fixed income investments or debt investments, or let me put it the other way around, which gave returns to policyholders, and these returns were more in line with the returns that fixed income investments or debt instruments gave. And that's why these were known as the traditional insurance. To offer another option for people who believed in investing in insurance policies, like it's been quite a few number of years back now that these unit-linked insurance plans came into vogue. Now, the basic difference between these policies when compared to the traditional plans is that the premium paid for this policy will have broadly two components. One is the component which takes care of the insurance cover that the policy provides, and the rest is later invested into different types of investments. And we have broadly investments which, or rather I should say funds, which invest in a mix of equity as well as debt, or in various combinations of these two asset classes. So these policyholders now have an option to not only invest in insurance policies, but at the same time enjoy market-linked returns if they choose equity funds for their investments in ULIPs.
Okay, so basically the premium outside of what goes towards the life insurance cover that is provided is what goes towards the fund that the insurance company invests in a mixture of equity and debt. Is that why ULIPs have been compared with equity mutual funds in the past, because the returns have been similar in the past? And is that an apt comparison?
So the $1 million question, which has been and still continues in a lot of people's mind, is whether one should look at ULIPs or whether one should look at mutual funds, because you have people advocating either of them or a mix of them. So the debate has always been whether you should invest in insurance or have insurance only for the sake of having the insurance cover, and invest the money that you aim to invest in mutual funds. Alex, in my view, I think each of these products serves a different need for every investor, because over the past many years, we have met people who like investing and who understand mutual funds and want to invest in mutual funds, but somehow are not very disciplined or don't regard themselves as very disciplined investors. So the fact that mutual funds are open-ended and the money can be liquidated at any point in time and withdrawn serves as a dampener for such kind of investors. And they believe that ULIPs or insurance plans are better because these are locked in. And while you get to participate in the market upsides by investing in these plans, at the same time, they're not lured to probably withdraw the money from these plans at their will. So the longer lock-in in these products is what serves these kind of investors better.
Okay, So this is a mode of investment that you're essentially talking about. But the other big talking point, Arvind, and leading up to the Union Budget 2021, that is the last budget, is that ULIPs enjoyed both the benefit of a deduction under ATC, and they enjoyed the benefit of saying that the proceeds at the end of the term were tax free. Now, the government has moved to curb that to a certain extent. So, shall we talk about the latest regulations and why it was necessary for the CBDT to come out with a clarification? First, let's talk about what was introduced in Budget 2021.
Yes, Alex, and for this we'll have to probably spend half a minute to go back to 2018 when the budget introduced long-term capital gain tax for gains made on equity mutual funds and equity shares. So while mutual funds were now brought into the tax net, ULIPs, which also invest in equity markets, were left out of it. So like you rightly pointed out, the Section 1010D exemption continued for ULIPs, which did not bring ULIPs at par with mutual funds. And hence, last budget now introduced a taxation on what can be called as a high premium ULIP, which means that all ULIPs that have been taken after 1st of Feb 2021, if the annual premium that one pays for any one or more of these ULIPs per year exceeds 2.5 lakh of rupees, then on maturity, whatever consideration is received by these policyholders, the same shall be taxed in the hands of the policyholders. So as a byline, in case one takes multiple policies after 1st of Feb 21, it says that the exemption on of this 2.5 lakh shall be restricted to only those policies or policy where the aggregate premium does not exceed 2.5 lakh per annum. Now, let me also talk about how is this ULIP taxed. So just like equity mutual funds, the consideration received for those ULIPs which are taxable will be taxed as capital gains, and the tax will be levied on the gains which is measured as the difference between the consideration received minus the premiums paid over the tenure of the ULIP. So this is in a nutshell how the taxation of ULIP changed last budget.
Understood. Now, you also sent us a few examples to elucidate this, because I think it's a little difficult to, my mental math is certainly not as good as yours, Arvind. So let's talk about a few examples that will help elucidate the points that you've been making.
Sure. So it's just a matter of coincidence that although this provision was introduced in the last budget and we are probably just like less than a week away from the next budget, on the 19th of this month, the CBDT issued a circular which was more like clarifications that they came out in relation to this new ULIP taxation. So the said circular, which has beautifully enumerated almost 10 situations talking about how ULIPs would be taxed. So let me take a few examples step by step here, Alex. First, let's visualize a scenario where, let's say, Mr. Alex, for example, has taken us ULIP in the year 2011 and has been paying a premium of 5 lakhs per annum for this policy. And this policy is due to mature in March 2023. So will the proceeds received under this ULIP now be taxable for Alex? The answer is no, because it doesn't fit in the criteria, in the first criteria, which is the ULIPs should have been bought anytime on or after 1st of Feb 21. Since this ULIP was bought in 2011, the entire proceeds received continue to be tax-free. Now imagine Alex on 1st of April 21 invested premiums in 2 ULIPs where the premiums were for 1.5 lakh and 1 lakh per annum. Now in this case, what happens when these ULIPs mature? The answer is that since the aggregate of the premiums paid per year for both these policies sum up to 2.5 lakh, which is the threshold prescribed, even now in this case, the entire consideration received by Alex on maturity of these ULIPs will continue to be tax-free under the same section 1010B. Let me paint another scenario here. What if Alex takes two policies on the 1st of April, both with premiums of 1.5 lakh each? Now, in this case, when these policies mature, any one of the two policies. So I would put my hand to say that whichever is the first policy to mature, those proceeds will be tax-free because the premium per annum paid for that policy is 1.5 lakh, which is below the threshold of 2.5. Whereas the second policy, the entire consideration received on maturity of the second policy will be taxed in the hands of Alex because it exceeded the 2.5 lakh threshold. To talk about mental maths, Alex, let me make this example a little more complex here, where Alex chose to take four policies. All the four, out of the four, two have been taken on the 1st of April 21 with a premium of 1 lakh each. And the next two taken on the 1st of April 2022 with a premium of 1 lakh and 1.5 lakh each. Now, all these four policies, let's assume they have different maturity dates, starting from 25 and up to 31 and the year 32. Now, here, Alex, I can see two options for Alex here. One is that since the policy, first policy and the second policy, where the person is paying 1 lakh per annum premium, since it is below the threshold, you claim the consideration received under these first two policies as totally exempt and pay tax on the consideration received for the third and the fourth policy when they mature, because all the four policies put together, the premium aggregate comes to close to 4.5 lakh of rupees, which is beyond the threshold of 2.5 lakh. Right. But I have another option here, which is instead of keeping the first policy consideration exempt, if the policy holder chooses to pay tax on the first policy when it matures, he can then claim an exemption for the policy proceeds received for the second and the third policy, which is policy B and policy D in this case. Why I'm choosing policy D over policy C is for the simple reason that policy D has a premium of 1.5 lakh per year, which by itself implies that the consideration received on maturity for this policy will be higher than a policy where you are paying only a 1 lakh premium per year. So you claim these two policies as exempt because the sum of these premiums is coming up to 2.5 lakh, which is below the threshold. And then you end up paying tax on the fourth policy for which you are paying 1 lakh. Now, Alex, I'm totally with you when you say that these maths is really complex, because what it entails now is to keep a track record of all the ULIPs that you have, especially the ones which you have taken anytime on or after 1st Feb 21. Keep a track of how much is the total premium coming to and which you want to claim as exempt and which you want to offer to tax under the new provision. Yeah, I mean, things are not very easy, and that explains why a long circular has been issued by CBDT now, because it has tried to enumerate as many possibilities that it could foresee, and has given very beautifully the way a policyholder can claim exemption or offer to pay tax on these policies.
So just a very quick summation, Arvind, just to get to the bottom line, and we have a little time because we're running out of time on this particular segment. But would you say that it's best to stay within that 2.5 lakh threshold and then invest everything else that you have to in mutual funds?
For
or
people who
individual equity?
So for people who love to keep their life simple, this is this circular enumerates that it's best to keep the ULIP premiums to 2.5 lakh, and yes, use other equity options to for their investments.
Okay. All right. Thank you so much, Arvind, for joining in. I've certainly feel like more than anything else, my mental math has improved from the end of this conversation.
Thank you, Alex.